Welcome everyone. Thanks for joining us for another session on options education. My name is Ed Modler, the Director of Retail Education at the Options Industry Council. This is a presentation that I gave to the BlackBox group earlier this year. I'm going to do it again because volatility is important, and it turns out that it certainly is a bit timely considering what we have going on in the markets today and in the coming days. So we'll talk about volatility from a basic perspective and then move it along a little bit further into strategies. Here's our disclaimer and who we are. OIC was founded back in 1992 to provide free and unbiased education to the investing public. The exchanges got together and wanted people to understand options and dispel some myths, so they created OIC. That's where we come from, and we're going 27 years strong. Website is optionseducation.org, specifically on our events tab. If you go to that website, you can sign up for our upcoming events. Next month, we have 2 webinars. I think we're going to talk options pricing and then synthetics and put call parity, all that kind of good stuff coming up in November. And the Investor Services Desk, options at theocc.com, is a team of professionals you can utilize to send your questions to, asking about what we offer or asking options related questions. They are former traders and brokers and fully qualified to help you out. The outline will start with the most simple definition of volatility, just so we can all be on the same page before getting into historic versus implied, and I'll touch on the concept of historic implied volatility, which really is what matters, and then using implied, what do you actually do with it? How does it matter? We're gonna have some calculations and computations along the way, but I'm not a mathematician. I was only a math major for 1 year in college, and I had enough of that. And then I moved into the business school, but there will be some math in here. We'll make it nice and simple, and then talk strategies, do all of that in maybe 45 minutes or so. And if there's any questions, I will be glad to answer those. Starting with volatility, everyone knows a lot of the things I'm going to say today are rather intuitive and people will completely understand. Volatility is just simply fluctuation in price. And for our purposes, it's fluctuation in the underlying stock price. It does not matter where you start and where you finish. It's what happens in between. And stocks that have higher highs and lower lows than their counterparts are considered more volatile and have the potential for a wider range of future stock prices. And that's what we're concerned about when we trade options, not what has happened, but what will happen in the future. So those more volatile stocks are going to have a little bit of extra premium, and that foreshadows what we'll get into through the presentation today. Of course, every stock is a little different. Every industry is a little different, and you can pick and choose if you prefer to trade more volatility. A lot of option traders do. Then you can go gravitate towards those that offer higher volatility levels. A lot of investors like to use options, but be in the less volatile names. You can certainly still benefit from buying options or selling them if you're a put seller or if you're writing calls against stock positions. It's all about your risk tolerance, your investment objectives, and putting that together. Sometimes the less volatile, lower implied options are the best trade, even if you're selling, because it offers you the best risk reward and is a name that doesn't scare you as much as some of those high flyers. First, historic volatility. This is looking back into the past of stock movements that have already occurred and then calculating based on an analysis of those previous stock prices, how volatile has this stock been? And that's simply all it is. If you're analyzing or looking at historic volatility, you can choose for yourself what range you would like to use, and by range I mean, do you want to look back at the previous 10 days or 30 days or 90 days? You can go back as far as you want to get a handle on how volatile has that stock been over that time frame. You can choose. I would say 30 days is probably the most popular, but your time frame on how you trade and the time horizon that you're using to select expiration dates may help you decide how far back do you want to go, how much do you want to include in the historic volatility calculation to be the most meaningful to you as you're making trading decisions. So here's where we're going to get into some numbers. As I said, historic volatility looks back. It references stock prices, and specifically, it's the annualized, and that word's going to come up a few times today, annualized standard deviation of daily price changes. Doesn't reference up or down. It could be in either direction, but it centers around an average price. And simply put, and we're gonna get to a little bit different analysis in a second here, but looking straight at the math, we assume a log normal distribution. For those of you with more of a math background than I, you might understand that a little better. Log normal versus normal distributions just means that when you have a normal distribution, you have an equal possibility of the underlying price going in either direction, but it includes the possibility of negative value. So you truly can go in either direction equidistant. Log normal references a price that cannot go to zero, and that's why we use log normal for historic volatility in stock prices, because stock prices are bound by zero. Stock's at 50 and you're assuming it can go either way. Well, the upside has a lot more potential because it's not bound by any numbers. The downside is bounded by zero, so log normal has this skewed distribution as compared to a normal distribution. And what it states is that you would expect that prices would remain within that one standard deviation 68% of the time. And we're going to calculate that on the next slide and then take it further. 2 standard deviations away, or doubling the annualized standard deviation, you would expect the prices of the stock to stay within that range 95% of the time. And then of course 3 standard deviations is going out 99. Let's try and make a little more sense of that. Here we have an example. Stock prices of XYZ over the last year averaged $100. That's the mean that we're looking at. And it's been calculated using, say, a 30-day historic volatility, that the standard deviation is 25%. Well, what does that mean? That one standard deviation away from $100 is $25, and you can simply just calculate that out and then double it for 2 standard deviations and double it again for 3, and that's really all it means, is that you would expect the stock price to be within that range that percent of the time. This is going to be a little bit more clear and maybe meaningful when we're going to do the exact same thing once I get into the implied volatility discussion, which is really what we focus on when we're trading options. But keep this in mind, historic volatility, looking back at previous stock prices, and then you have an idea here of what that number actually means. More than likely, instead of calculating out the standard deviation moves and the ranges, you might be using this just to compare one stock to another. One is at 25, one's at 15, one's at 35, and now you know what those differences are. And that's how this would look. So I'm gonna get my pointer out on this one. As we see, the least volatile stock A, is here in this gray line, and this is very intuitive. Nothing here is complicated, but centered around the mean. The stock A with the lowest volatility has the highest likelihood of staying in this price range and very low likelihood of drifting too far. The range here of possibilities is the least, and you go all the way up to stock C with 35%. Right where we're at $100, it has the least likelihood of the 3 to stay at 100, and it has the widest range. The possibility of moves outside from 100 are going to be much greater than the lower volatility issue of 15%. Nothing too crazy there, nothing too complicated, and that's historic volatility. Now we want to take that concept and translate, because implied volatility is now different. The calculations and the numbers are similar, but implied is meaningful to options because we're not trading an option based off of what the stock has done. We're trading an option based off what the stock is going to do, or our expectation of what it's going to do. The market is continuously trying to predict what the stock is going to do between today and expiration day. And it assumes a volatility level associated with that time frame, and then uses that volatility level to price the options contract. That volatility number is going to be annualized. We'll see that again in a couple slides like we did before. But here we're looking ahead. We are here today, and we can calculate historic volatility looking back at the stock price movements. Implied volatility may look similar to what has happened in the past, or it could be totally different. And this is what makes a market. Some investors will think that the implied moving forward is going to be more or less than historic volatility, and they'll make a trade-off of that, as others have different opinions. Now, this is not a rule, but it's also somewhat widespreadly believed, if widespreadly is even a word, but widely believed that implied volatility is generally just always a little bit higher than historic volatility. And I try and explain this from a common sense or from a perspective point of view that if you're selling options, you're taking on a risk, you're taking on obligations, and you'd like to get paid just a little bit more than that expected move or what you've seen in the past. This is similar to insurance companies who know based on years and years and years of analysis what their expected payouts are going to be. Well, they're not going to charge you an amount for them to break even. They're going to raise that a little bit to take on the risk they do that something incredible happens and the market moves in a fantastic way and they are out a lot of money. And for that reason, it is commonly understood that implied volatility might always be just a bit higher than historic. So comparing them directly does have that one little caveat to it. Now, implied volatility, so as I said, it's the volatility assumption from today moving forward up until expiration date that the options market or the market makers believe that the option is, or that the stock is going to move, and it prices the option appropriately. Ultimately, supply and demand is what is going to drive prices. Now, one question that you may be thinking of is, well, if supply and demand is driving implied volatility levels because it's moving prices up and down, and well, what happens with new issues? If there's an IPO, how do they set volatility levels? And that's a great question, because it's rather difficult when a new IPO comes out to know how volatile is this going to be. So when you have those kinds of new issues, then you can look at other stocks in the industry, you can look at historic levels of comparable issues and try to determine what you think volatility levels will be. But that's when you might see bid-ask spreads fairly wide, because the market makers and the professional community is giving themselves some flexibility there. They might not be right on where they're going to start their implied vol levels. Same question, but a little bit more specific answer when there's a new expiration month. Every month options expire, every week they expire and new ones come on the board. Market makers need to know what implied vol level are they going to use for that new expiration term. They don't have supply and demand to drive that, but of course, as you may suspect, they use the other weeks or the other months to determine where a fair level of implied will be for that new issue. That's where it starts. And then as bids and offers and order flow comes into the marketplace, volatility moves up and down based on what's happening from market participants. So comparing the two, historic versus implied, and then this concept of historic implied itself. Implied could be very different from where the historic volatility is. When that's the case, I've heard investors say that when an implied vol is much greater than the stock's historic vol, then that means options are expensive. And I would just be careful with that term. While I wouldn't disagree that it looks like they're expensive, and I wouldn't equate an expensive option with an option that you should be selling, because there might be a very good reason why a stock's implied volatility is much higher than its historic volatility. We're trading through earnings season right now, so you probably have noticed prior to earnings announcements, implied volatilities are going to look very high, and those are tempting options to sell sometimes, but earnings season is a great time to trade options because volatility is moving up and down. It's all about magnitude of moves, and we'll see that when we get to strategies at the end. These volatilities they're changing all the time, not just because of big announcements like earnings or corporate announcements, but anything moves volatility. When I was on the trading floor, one of the perhaps the most important part of my job on the trading floor was to set and reset the theoretical option values that I was using to make markets. When a broker came in the pit and asked for a market in a particular option, I was giving a bid and an offer, and I was centering my market around the theoretical values that I was looking at, and I could set those values myself. If a broker came in and he was asking for a market in the 60 strike call option, and I gave him a market and he sells 1,000 options to the pit and he breaks them up amongst us, 50U, 100U, and breaks them all up and sells them. Well, the next time around, I'm not so inclined to buy more of these things. I want my theoretical to move down just a little bit so my bid drops and my offer drops. And if I'm going to buy more, it's going to be at a better price. Well, the way for me to do that, one way is just manually to lower your price and know where you're at. But in the computerized system, which is when I was trading on the floor, we're using handheld computers. I could call up a volatility curve for any stock in any month I wanted, and literally with a pen that pointed on my handheld computer, click on an area of that curve right around, say, the 60 strike, 65 strike, and drag the volatility curve down, submit that, reset my theoretical values using lower implied levels for those strike prices, and then that would lower my theoretical values and help me make faster, quicker markets because I didn't have to remember where I was. I can just reset my theoreticals. Did that all day long. And a little more about the market making community, professional community. There were times when I was already short those options and I wanted to buy them. Well, in those cases, maybe I didn't move anything, and other traders in the pit may have been long and they didn't want to buy more, so they were moving their vols. So not everyone's always doing the same thing. You're analyzing your position and what you want to be doing, and then you're changing volatility levels based on those two factors. What is my position and what kind of order flow is coming into the pit? But generally speaking, as offers are coming in and the paper order flow is selling options and you're buying them as a professional, you are lowering your theoretical prices. The only way to do that is by lowering implied volatility levels. That's the way you accomplish lower theoreticals. So now the question becomes, if the implied is out of line, will it return to its historic levels? And it's a common thought that volatility levels do gravitate towards their long-term mean. Personally, I would say that that's a reasonable expectation, but not always the case. Sometimes there's a new norm, or a stock has entered into a condition that's different from what it's been involved with previously. So different circumstances lead to different future stock volatility versus past volatility. You have to take that into consideration. If volatility had been 35% and now it's 45, maybe that's the new norm. I don't know if it's going to go to 35 or not, but even if it is, when is that going to happen? It's a tougher decision to make. And this is when I'll discuss the concept of historic implied volatility. What that means is you're taking into consideration historic somewhat, but it's not so important. What really matters is the current levels of implied volatility compared to previous levels of implied volatility, somewhat taking the historical part out of the picture, other than being aware of where it sits. The important part with options is comparing apples to apples. Today's implied versus last week's implied, or last month's implied or the average of implied volatility over the course of the last month or 6 months or a year, and comparing that to today. That is a direct comparison of the two to determine where does today's level of implied sit versus the past. Now, that's not easy to do for an individual investor. It takes a lot of deep analysis and access to data in order to get that kind of information, but that really is the direct comparison. You could get that implied level from our website. We do have a historic and implied volatility calculator where you can type in a symbol and get that on our website. You can certainly ask the investor services guys about that, but not the easiest analysis for an individual investor to do, but that would be the way to do it. Compare those two implied levels to each other. Now, when implied volatility changes, option prices are going to change. I just outlined that and walked through it with what I was doing in the trading pits on the floor. When volatility goes higher, both call and put prices will increase because volatility does not imply a direction. So as implied volatility moves lower, you have call and put prices both decreasing. Well, this makes sense. And of course, it's all other pricing factors remaining constant. This is what is going to happen, and it will change. If you're curious, well, how much is it going to change? It will change by the vega amount. Vega is the Greek associated with implied volatility. And for those of you not too familiar with the Greeks, implied volatility itself is not a Greek. It's an important factor in the option price, but vega is a Greek. In vega, the number will tell you how much is this option price going to change with a 1% move in implied volatility. If you're trading a stock before earnings, it would be essential to know what is the implied volatility level that I am buying or selling before earnings. Where is it? And where was implied vol levels right before the previous earnings announcement, or the one before that, or before that? Know where that is, so you'll know what magnitude of implied vol you're trading compared to previous events. And then after the earnings event, you can check again to see, well, how much did it get crushed? It's going to get crushed. How bad was it? And looking at those numbers will help you evaluate, will sometimes help you evaluate the change in the options price. If you don't look at those implied levels, you see the stock price move, you see the option price move, sometimes they don't really match up, and you're wondering why that is. Well, the volatility crush after earnings will certainly play a role in that. And here's an example, stock trading for $50, and we'll just look at the at-the-money calls trading for $3. And after a trading day occurs and the stock moves crazy, but stays at 50, hasn't changed in price at all, we certainly could see the price of the option increase to 340. So one day has passed and the stock is right where it was the previous day, but the call price went up. The only thing that could have possibly happened here to cause this is implied volatility went up. So you can see that these Greeks, they work sometimes in the same direction and sometimes they counteract each other. In this case, the stock didn't move, so delta did not help the option price change at all. One passing day, the theta decay would have actually had a negative impact on the option price. But with volatility increasing, in our example from 35 to 40, with volatility increasing, the call price actually went up. So vega, the move from vega, outweighed all of the other factors in the option price, and that's what can happen here. I'm going to look at the numbers that we did for historic, but in a slightly different context here with implied stocks trading at $80, and we have the options trading for a 30% implied volatility. Again, if you're not going to focus on implied being high or low when you're trading options, it really is critical to at least look at the number and know what am I paying or what am I selling. If you're not looking at that, it's almost like buying something and having no basis for how much you're actually paying if you're not looking at those implied levels. So checking out where it really is important. The numbers initially don't appear too useful. 30% on an $80 stock. If you just do the math there, that's $24. So statistically, and this is an annualized number, statistically, you would expect the results for XYZ over the next year. You can see that trading range, one standard deviation, 56 to 104, 68% of the time, and 32% of the time outside that range. Well, your first thought may be, well, that's not really helpful. That's a pretty damn wide range, 56 to 104. I could have told you that. So what do you do with that? And I would agree that that range is not something you can really work with. But often you're not trading options looking out a year. So let's remember this is an annualized number, and try to do the math here. Let's say you're looking at an option that expires in 1 week, and the implied volatility is 30%, annualized 30%. You're looking out just 1 week, which roughly 1 week out of 52 is about 2% of a full year. So one standard deviation move of 30%, only looking out 1 week, is actually going to be 2% of $24 or 48 cents. So over the next week, a 30% implied volatility will state that the price of the stock would be between 79.52 and 80.48. I'm taking a plus or minus of 2% of the $24 number and getting the range there. And that might be a little more useful to you when you're looking at the option prices. 2 standard deviations, double that. Then you go to roughly 79 and 81. If that's what the volatility level is, then you can see the probability that the market is telling you that the stock should be in. So now you have something to work with. 70, so let's say 79.5 and 80.5 are those numbers. You can see what the options are trading at. If you're considering selling the 79.5 puts, you at least know that the market thinks there is a 70% chance, roughly 70% chance, that the option is going to finish out of the money. And you can use that to help make some trading decisions. If you go out further to standard deviations, again, that 1 week or 2 week calculation might be more useful for you. And going out further than that, you can just keep the math going. Excuse me. So let's move into the strategies, and this is where things get fun. You're trading around earnings season, looking at volatility, and that's where strategies come into play. And there's a few strategies that really focus and hone in on volatility itself. As you might expect, neither of these strategies focuses on one direction or the other. They focus on either direction. So that's going to certainly involve calls and puts. And that's what we're going to look at here. A straddle involves buying a call and a put, or selling both of those options at the same strike price and same expiration date. And usually, undoubtedly, these trades are done using at the money option, looking to take advantage of a big price move or a volatility spike in the case of long straddles, or a crush in volatility in the case of short straddles, typically before and around certain events. It doesn't really have to be that way, but typically that's the way it is. Excuse me for a second. All right, I hope that's not the beginning of a cough cold, but so typically around earnings events, drug trials, it doesn't have to be. If you're doing a fundamental or technical analysis, you may think a big move is coming, or the market is expecting a big move, but it's not going to occur. That can happen around new highs, new lows, inflection points, any of the above, where the direction doesn't matter, but the magnitude of the move does. Now, when you're trading these things for an event, usually they do get closed out after the event. Buying a straddle and we'll focus, say, before an earnings announcement. In this case, stocks trade in 87.5. So we're going to buy the at-the-money straddle, the December 87.5 call and put, add those together, and we get $4 as the net debit between the two. Now, again, we don't care what direction the stock moves, but we just want it to move at least $4. That doesn't necessarily have to move $4. If there's a big enough move within the first day or two, we may be able to exit this position for a profit. But looking out to expiration, we would need at least a $4 move in order to capture that. Now look at one thing I want to point out here that you may hear a lot. Look at these two prices. You have 87.5 and looking at $4. A lot of times you might hear an economist or a commentator on TV say that, well, before earnings, earnings coming out in a couple of days, the market is expecting a certain magnitude of move in the stock. Or they might actually specifically reference options and say the options market is predicting a certain magnitude of move in the stock. There's a couple of ways you can make that calculation, but most often it is by looking at the straddle market. And let's say right before December expiration, there's a big announcement coming out. And these options are the nearest expiration right after that announcement. And you could buy this at the money straddle for $4. So let me just do the math on that. $4 divided by 87.5 is about 4%, 4.5% that you would need the stock to move to break even on the straddle. Beyond that, the buyer makes money and the seller loses. And if it's within that range, the seller wins. And of course, we're still looking at selling straddle, the same exact example. If the range is less than 4, the seller wins. They are trading around a 4.5% move. The buyer thinks it's going to be greater and the seller thinks it's going to be less. And that's what makes a market. And that's that expected move that you may have heard about. So you can see implied levels certainly matter a whole lot, but really it's about the magnitude of the move. And that's what you're trading with long and short straddles. Just focus an example here on the long straddle. Again, paying $4. Maximum risk is everything we put up, which is those $4, and we have our break-even points, $4 on either side of our 87.5 strike. And that's what the profit and loss graph looks like for the buyer, the one who's thinking the move is going to be greater than 4. That they're not just going to get a move higher or lower, but it's going to be greater than 4.5% of the current stock price, and that's what it's all about. Now, I was trading, this is going back to the late 90s. I was trading for a firm who was strictly trading implied volatility levels. That's all we did all day long, was buy and sell implied volatility levels, and we were trading straddles all day. That was it. When we thought implied vol was currently low, we were buying straddles, and we thought it was high, we were selling straddles. And of course, we tried to balance those out, the buys and the sells, so we didn't have too much overall Vega exposure on one side of the market or the other. But that was the idea, trade implied vol. And in doing so, the only strategy we used was the straddle from the long or short strike. And then the other cousin strategy of the straddle is the strangle, which is the similar type of trade, except you're still buying a call and a put or selling a call and a put. The only difference here is that you're staggering out and using out of the money options instead of at the money options. That changes the dynamic a bit, and we'll see the P&L graphs towards the back end, one of the final slides. And what you're doing is you're changing the structure when you do that. The buyer, we'll look at an example. The buyer is now going out further on either side, the 90 call and the 85 put, and the seller's doing the same exact thing, receiving a net or debit. And again, direction doesn't matter here. The buyer of the strangle is expecting the stock to go not just above 90, but by a magnitude of at least $4. You need a big move when you're a strangle buyer And that's because you're buying out of the money options. You're also buying two of them. One of those options is going to do nothing for you. So you need a large move. This is a more aggressive trade because you can lower your cost if you go out far enough in strike prices. If you really thought, similar with just buying an outright call, let's say, if you were extremely confident in that move higher, your most aggressive move is to reach up higher in strike price. It's going to cost you less, and your rate of return is going to be much, much more. So when it's a more aggressive play if you were highly confident that the move in this stock was going to be greater than the market is expecting, again, in either direction, then that would lead you to a strangle. On the short side, selling a strangle is selling volatility. You know it's going to get crushed after earnings, but whether or not you make money depends on how big a move does the stock make. You know that implied vol moving lower is going to help you out, but is the delta on one of those sides going to hurt you more than you gain on implied volatility? That's what it's all about. Selling a strangle versus the straddle means you're receiving less premium and less capital up front, but you do have a wider range of profitability. Let me get to an example. Here we have the 90.85 put, 90 call 85 put strangle. We're going to buy this for 250. Got our break-even points, just calculating that on either side of our strike prices of 250, and the P&L graph looks like this. So you can see in between the strike prices, we get nothing out of this. Buying the strangle pays off nothing. And even if the stock moves, you need a pretty decent sized move there, at least by expiration, in order to profit. When you're trading an earnings report or a corporate announcement, it's likely that you're using options that are just about to expire right after the announcement. So if you don't get that move you were looking for and the announcement is over and it's done, there's a good chance that the premium in those options gets sucked out really quick. So you might not be able to bail and sell these things for anything, and you need a move. So saying the stock's at the current price of 87.5, this is where I'll get questions from investors that say, well, the call was trading $1.20. The stock moved up to 89. It's $1.50 now, but my call option lost money. Well, it didn't even reach your strike price. And if you're not understanding implied volatility levels, then you're not going to understand why that happens. A stock moving up from 87.5 to 89 means that the move higher, the $1.50 move higher, actually had a positive impact on your price of the call option in the form of the delta. The delta had a positive impact, but the change in implied volatility levels, if it's great enough, would have had a negative impact. So you have to manage between those two things. Now let's look at a comparison between the two: straddles, long and short; strangles, long and short. And you can see if you're buying the straddles, certainly they're going to cost more using at the money options versus their counterparts, the strangles, using out of the money options. The cost is going to be less, and your break-even points are going to be different as well. But one thing I mentioned earlier, the expected move. You may hear economists or commentators talk about the expected move of a stock price prior to an announcement. And I gave you that first equation or calculated method, which used straddles. How much is stocks trading at 100, and the 100 straddles trading for $5, and you're using options that are right after the event. Well, that's $5 out of $100 strike price. That's 5% that the market is expecting. Well, there's another calculation some people will look at. It's usually done for options that have a lot more strike prices, and the width between the strike prices is a little bit smaller. They'll take the at the money straddle and then add to it the nearest out of the money strangle, taking the nearest put strike and the nearest call strike, add all of that together and divide by 2. And they'll calculate the option market's expected stock move that way. Now, if you're looking for an explanation of why they would do that, I'm going to go way back to something I said near the beginning of this. it might be the case, or you might expect, or be one of those investors who feel that implied levels are always going to be just slightly higher than the market actually thinks the stock is going to move, because sellers want to be rewarded for that. They deserve, or they require, just a little bit more premium to take on the risk associated with selling options. Well, if you do this ladder computation of taking the straddle, strangle, adding them together and divided by 2, you actually are going to somewhat reduce the expected move, and to a certain extent compensate for that maybe slightly inflated implied vol number that's out there if you just looked at the straddle itself. So that straddle calculation is a little more direct, just using one strategy. Using 2, adding them together, divided by 2 is a little bit different. As I said before, you have to look at what strike prices are out there for lower volume stocks. Those options may have wide strikes, and the strangle may make too big a difference. It may lower it by a whole lot. But if you have half strike intervals, or even dollar strike intervals for higher price stocks, then certainly that other computation could come into play. Key points to take away, and this is all simple to understand, just nice to be aware of it. Historic vol is where the stock has been. It's got its place. It has its relevance. You want to know. If you're going to try and predict, I'm looking at a 1-month option, what's the stock going to do over the next month? It's nice to know what it's done over the last month, or the last 2 months or 3 months. But that's it. It's got its place, but it has its limitations. Implied vol, specific to options. You'll only find it in the option itself, and it's the market's expectation of what the stock price is going to move between today and expiration date, and that number is expressed on an annualized basis. You can back out the numbers. We did it earlier to get yourself the range and do the math. 1 week, 1 month out, just do the math by de-annualizing that number for the time frame that you're looking for, and that may give you a range that's more useful to you than the two strategies that are the bread and butter of volatility trading. They both involve calls and puts, which means they don't have a directional bias, buying them both or selling them both. And of course, when it comes to selling them, many of you probably aren't going to be selling strangles or straddles because of the risk profile associated with that. But if you wanted to take advantage of the concept of selling straddles and strangles, instead of just dismissing the idea, selling a straddle would accomplish the same thing if you sold an iron butterfly, which just simply means you're selling an at-the-money straddle, and then you're buying a call and buying a put at further out strike prices, as far out as you want to go, to protect the risk. That's a very viable trade. And same thing with selling a strangle. And I didn't go through the iron condor here, but because the strangle is the direct entry to volatility, but many of you are not going to sell a strangle because of the volatility, not just because of volatility, because of the upside exposure and the downside exposure associated with that. It just might be too great for you. But an iron condor accomplishes the same thing as the iron butterfly does. You're selling the call and put, and then going out further on both ends, high on the call side, low on the put side, and buying options to protect. So same deal there, taking advantage, hopefully, of a decrease in volatility where the stock price movement did not overcompensate for that decrease. And that's what selling the straddles and the strangles is all about. Contact information back on the board, the investor services team. If you want to look at our tools, specifically historic and applied volatility tool, those guys know where it is and they can help you walk through it. Check out our YouTube, and again, please sign up for the OIC's monthly webinars. We're really proud of those. We did a full series yesterday. If you wanted to go back and listen to myself speak with some industry and exchange personnel. We also had Larry McMillan yesterday. If those of you may know him, one of the most premier names in the business. So you can sign up for those events and others. And that takes me to the end. My voice mostly held up, kind of, sort of, but then caught me by surprise. Hopefully that didn't distract people too much, but that's what I've got. And I'm not sure who's coming back on the line. Maria, you might have a few Q&As.
I'm right here.
Okay.
I'm right here. Guys, thank you so much, Ed. I appreciate it. Again, an awesome class. Guys, if you have questions, go ahead and either type them in Discord or type them in the questions box and we will get them answered. Mel saying, thank you, amazing class. Julio is saying, excellent webinar. Yeah, this is a good class. I like this class a lot.
I'm glad they liked it. I didn't expect the cough to come on, but right 2/3 of the way through, my voice started losing it. That happens.
It does happen.
Maria, I don't have any questions on Discord.
Okay, cool. Special Doctor's asking, how can you see if the price of an option is too expensive?
Well, let's see. So what I would do is I would be comparing today's level of implied vol to past levels of implied vol. If today's level is higher, then I would consider it expensive. But I think one of the things I said earlier, that's not necessarily a situation where you automatically sell. You then have to further evaluate and ask yourself, why is today's implied vol higher than previously? And of course, we're right in the middle of earnings season. If you were doing that over the past week or two, you would see really juicy option premiums out there for good reason. The stocks might move tremendously more than they normally do after earnings announcements. So you have those expensive options, but if you sold them, you may have gotten killed because of huge stock moves. Some of these earnings moves have been massive. So expensive is one thing, selling opportunity is another, but the way to really compare option prices to one another and determine expensive or cheap, or I should say inexpensive, is to compare current levels of implied vol to past levels of implied vol. No real easy way to do that other than gathering data, keeping data, or tracking on your own where implied vols are one day to the next and then getting a feel for it. That's the way we had to do it when we were trading vols professionally.
Julio, well, real quick, because I've got like 4 or 5 people asking this. Yes, this is recorded. You will use the same link that you registered for the webinar. You'll use that same link to access the recording. So you click on the link like you're gonna register for it, and it will take you to a recording. Yes, it is recorded. Julio wants to know, is it a good idea to go long on a straddle and then when IV dies, you sell one leg and hold on to the losing leg until it breaks even?
Let me see. So you buy a straddle, and then I think it said when vol gets crushed. Is that what
Correct.
that said?
When IV dies, when vol dies, you sell one leg and hold on to the losing leg until it breaks even.
Well, I think maybe that is that assuming one leg is profitable or at least has value. So you bought a straddle, the stock moves a little bit, you sell off one leg. Well, it's hard really to say, because I think every situation is going to be a little different. If you buy a straddle, say the 100 strike straddle, and earnings comes out and it's kind of a dud, vol gets crushed, but the stock moves down to say 98, you're still underwater. You know, are you going to sell the put for $2 and hope the call becomes worth something, or you just ride that put down? And you know, there's really 3 things you can do: sell the put for 2 and hope the stock retreats the other way. And I'd say that's probably the least likely thing to happen. Your other choices are take your $2 and take a loss on the trade, mitigate your losses and get out. I'd say it's probably the most common. And then in between there would be just ride the put and then see if you can get more than $2 for it, since the stock's already moved that way. You know, it's really hard for me to say what the right way is to do it, because I really think in these types of questions in general, you know, should I do this or that when I manage the position? I always end up answering it as, you know what, I would make a different decision every time because every circumstance is different. So it's hard for me to be specific on that.
I agree. GD wants to know, how soon does IV reset for long leap calls post earnings or post a binary event? Is there any time frame for the IV to return to normal?
Well, first of all, when you go out very far, you're going to have a mitigated greatly mitigated effect on options. So the question I think will reference leaps. So look at a leap option. We're in earnings season today. If you're looking at an option today and you're looking at a leap option expiring, say next January, over a year out, there's really not going to be much of any effect before or after. Because think about it, that option has 4 earnings announcements priced into it. Yeah, one of them came off the board, so you may see a little bit of a change there, but I wouldn't think it'd be too noticeable. How often do they reset? Really almost immediately, but I do have to sort of say that assuming that the stock has made its move and it's done with its move. If the stock is really, and I'm kind of saying that because it's fresh in my mind, seeing some of these moves that we've had. If you have a huge move lower after earnings, that move may cause the next week or 2 weeks or months to be very volatile in that stock as people are trading in and out. They're cautious, they're adding more, they're doubling up, they're bailing, all sorts of stuff is going on. So I would say if the stock doesn't move a whole lot and the earnings announcement's kind of out there and the move is done and everyone's comfortable with it, that earnings in the near term expirations, the volatility I should say, in the near terms is going to reset right away. But if the stock is moving in a big direction one way or the other after earnings, of course, it's going to take a while for that stock to settle down. Again, kind of a vague answer, but the stock move is going to dictate somewhat the timing on when the implied vols sort of settle. And again, those long-term options should have a very muted effect because it's not just one earnings announcements they're worried about, it's a series of them. So you shouldn't notice much there.
Awesome. Chrome Dream wants to know, is it wrong to think of gamma as the IV of the option pricing itself, or is that not the idea measuring the rate of change of delta?
Okay, let me think about that one. So is it wrong to think of gamma as the IV of the option? Is that what
Of
that
the
said?
option pricing itself, or is that not the idea measuring the rate of change of delta?
Right, I'd say the latter of that. Gamma is really the driving force behind the option price with respect to stock price movements. And gamma is, arguably, and in my opinion, the most important Greek that large position managers take into account because they're concerned with, well, what if the stock moves up, what's my position look like? If the stock moves down, what does it look like? And it really is separate from that is your volatility analysis. So you have gamma attaching itself to delta, and delta is only dependent on stock price movements. It's really a separate idea that implied vols go up or down or get crushed after earnings, and then your vega, your other Greek entirely, is what you use to analyze that. As a trader, thinking about my days on the floor, gamma was always forefront to me. That was the one that I looked at, and we can get into a really long discussion here, but gamma implies things about your other positions. If you're long gamma, you're going to be losing, or you'll have negative theta, you'll have negative vega because it means positive theta because it means you're long options. So they're tied together in some respect, that your gamma tells you what your vega position is. But as far as the movement of the option price, gamma is attached to delta, delta is attached to stock price movement, and implied volatility is attached to vega. So I'd say it's more of the latter, that they're separate issues.
All right, what is the advantage of playing options on the day of expiry or perhaps a few days before expiration?
I think that question's probably looking at long options, buying them 1 or 2 days before expiration. I'll just answer it from either direction. I've done both, probably more on the sell side than the long side, but buying options at that really, really short time frame, a couple of things. The option's going to be cheap and your decay is going to be really fast. So if you're looking to spend a little bit of money and maybe hit a home run on a big percentage gain from a 1 or 2 day move, those cheap weekly or 1 or 2 day options can help you out. And I was inclined to sell 1 or 2 day options myself if there was enough premium that I felt was worthwhile doing. You do the annualized calculation. I really did do an annualized calculation looking out, say, a week, and saying, well, what's the annualized return that I'm getting on this put option? Option price versus strike price, what's the annualized return, and trying to see if that was juicy enough, trying to sell those because that time decay is so fast. during those last few days in that last week. If I own shares, I could sell calls and know right away what's the rate of return if I get called away. That's the worst thing that's going to happen. I own the shares anyway. If I sell this call and get called away, what's my rate of return? And if it looks really good, go ahead and do it. Same thing on the put side. Sell a put. If you get assigned, you're okay owning shares. If you don't get assigned on the put, what does that annualized rate of return on the premium you got for the put option look like? And when it's really good and attractive, those were the trades to make. But there certainly is a time and a place to buy options like that as well. If you really think a move is coming, and I think I referenced a few of these, marquee indicators before. If a stock's really bumping its head on an all-time high, and you're thinking this thing is going to go through tomorrow and blast off, well, maybe then buying call options with 1 or 2 days left might be worthwhile for you. I'd say those opportunities are a little further and farther in between, but certainly could be something you do occasionally.
All right. Can you please give a quick summary of when to use vertical spreads versus straddles and strangles versus butterflies?
Okay, so vertical spreads versus straddles was the question?
Correct. And strangles versus butterflies.
Well, I mean, they're somewhat different trades. Vertical spreads, I have to isolate whether you're buying or selling these things. If you're maybe the question was straddles versus iron butterflies, because vertical spreads is an iron butterfly. So I think maybe that's where they're going with that question. Why would you buy a straddle? Well, the straddle is bought when you have more confidence in the move being extremely large. So you don't mind paying up for the straddle because your confidence level is higher. It's a more aggressive move. If you are a little bit less certain, you think a big move's coming, it's going to be greater than the market is predicting, but you want to mitigate that somewhat, lowering your costs because you know that straddle is going to get crushed if the stock doesn't move, earnings comes out. That's when you look on the call and put side for premiums worthwhile to you, and you sell it to turn it into a butterfly. I used butterfly under the assumption that you're going equidistant on both sides. By no means, I should have stressed this earlier, when I traded iron butterflies or used options, even iron condors, by no means do you in the real world need to go equidistant on either side. That's the easiest way to explain the trade. But if the stock's at 100 and you want to say use an iron butterfly or an iron condor, you may think the upside or downside has more potential than the other. Oftentimes you do. And if you want to give yourself more room to make money on either side, one side or the other, stagger and those widths between strike prices more on one side than the other. But if you're buying a straddle, aggressive, very aggressive, if you want to turn that into a butterfly, you're a little bit less aggressive and bringing in premium worthwhile to you. Really the same thing. I think, what was the other one? Straddles versus what?
It was vertical spreads versus straddles and strangles versus butterflies.
Okay, so I think I answered that. I think I answered that. If you're doing the straddles and strangles outrights, you're more confident. It's more aggressive on either side, long or short. Putting the other options outside of it is a way to mitigate your risk if you have a less aggressive approach or market outlook. I think that answers it.
All right, the next question, and we can only take a couple more, guys. We've got 2 minutes left. How often is IV reset?
Every second of every day. Every single time I made a trade, and I was in the trading pits, just for example, in the trading pits when I was busy, I might be making 100 to 300 trades during the course of a day. Every time I made a trade and I bought or sold something, I was doing those two pieces of analysis that I gave earlier in the presentation. Is this what I want to do? If I'm long options, I'd like to be selling them. If I'm getting opportunities to sell options in the pit, I left volatility alone, but I was thinking about it. If I was already long options and I was buying more, I didn't want them, I was moving vol immediately. When order flow continued to come into the pit, if it was still selling to me, I didn't want to buy anymore. I'm moving vol again. All of a sudden, I may have moved it too far and I'm getting buy orders left and right. And I'm starting to sell. Well, if I'm moving vol too much, I'm just scalping against myself and I'm losing money left and right. This is why market makers lose their hair, because when you're moving vols that fast and that much, you're scalping options against yourself if you do it the wrong way. So how often is IVOL moving? All day, every day, as long as there's trading activity. If there's no orders coming into the pit and no trading occurring, then vol stays right where it is, but it's always ready to move. You can almost think of it like the market is always trying to figure out that level that is perfect volatility, where there's a bid, an offer, and nobody wants to make any trades. That's what the market is constantly looking for, and it almost never finds it because there's always bids and offers moving the market up and down.
Perfect. And we are out of time today, guys. Ed, once again, thank you so much for this class. It was great. It was awesome. We really appreciate it.
And my pleasure.
And I will
Glad
let you
to be
wrap up.
here. Yeah, glad to be here as always. I love doing these presentations for this group. Hopefully I'll get a chance in the near future. I know everyone has holiday plans, including myself. So wishing you and the team at BlackBox and all the listeners out there a happy holiday season. I will probably be back on the board for more presentations early next year, but I really enjoyed doing these and looking forward to doing more.
Thank you,
Thanks
Ed. It
again.
was
Happy
spectacular
holidays.
as always.
Thank you guys very much. We'll talk to you soon.
All right, guys. Take care. Bye.